So this is where we finished off last time, ladies and gentlemen. We were discussing the elements of financial statements. I know I had a few of you confused a little bit last week with discussing some aspects of chemistry, but that was just to illustrate what the meaning of elements are. So they are the basic building blocks of our financial statement. So we finished our discussion. We had quite a long discussion on assets, the definition of an asset, and we've broken that definition up into what we refer to as definition criteria. We also had quite a long discussion on liabilities, and we've also broken that definition up in definition criteria. We discussed a few examples there, ladies and gentlemen. So we have to continue now is with equity. Now, equity is actually very straightforward. It's simply the residual interest in the entity's assets after deducting all its liabilities, right? So that means that is what the business or that entity is worth to its owners. So it is literally its assets, the value of its assets less the value of its liabilities. And that is also the origin of what we refer to as our accounting equation. So here we can see that residual interest, or equity for that matter, equals assets less liabilities. And that is one of the topics Mr. Adams is going to be discussing later today. I've heard a few pings. My mic is very low. Yes, I've got a very weak mic, but I'm trying to sit as close as possible to the to the uh, 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 to the laptop. So hopefully you can all hear me fine. Yes or no? Is it okay? Otherwise, I to
It's fine, sir. We can hear you, sir.
Perfect. Thank you so much. Thank you. Okay. Like I say, I'm as close as possible. That's why I'm not even activating my camera, because then it'll look like I'm right in your face. Okay. Right, so that is a fairly straightforward one. Then we get to income and expenses. Perhaps let's discuss the income one first, and then we'll discuss the expense one. Obviously, the one is almost a mirror image of the other. So this is our fourth element of the financial statements. We'll see later on where they all fit in. So an income is an increase in assets or a decrease in liabilities. And that little word there, or, is quite important. It is not and, right? So it can either be an increase in assets or a decrease in liabilities. Going to come back to that in a moment, resulting in an increase in equity. In other words, this equity, your residual interest, will therefore increase, right? So that once again means either your assets must increase or your liabilities must decrease. But then it has a little qualification at the end here. They say other than contributions from holders of equity claims. Right, so let's perhaps just talk about the holders of equity claims so that we understand that term. That simply means the owners, right? So in the case of a sole proprietor, you remember 2 weeks or so, 3 weeks and 2 weeks ago, we discussed the types of businesses and business structures. So in the case of a sole trader, that will simply be the owner of that business. In the case of a partnership, it will be the various partners. In the case of a close corporation, it will be the members of the close corporation. And then obviously in the case of a company, it will be the shareholders of the company, right? So those are the holders of equity claims. So that means your assets must have decreased and your liability or your liabilities decreased. Did I say assets increased? Assets should have increased or your liabilities should have decreased, but not because the owners of the business pump more funds into the business, right? It must be a different reason. Then it qualifies as an income. So before we look at an expense, let's just have a look at increase in assets or decrease in liabilities, and then you can type a few things for me there, please. Now, if you look at your bank account, this is possibly the best example I can come up with. If you've got money in your bank account, right? If you've got money in your bank account, Is that then an asset or a liability? In other words, you've got a positive bank balance. Is that then an asset or a liability? Yes, it's a good thing. It's a good thing. Everybody agrees. Anna, I'll take your hand soon. Uh, it's an asset. Thank you very much. Right. So if you have an income, ladies and gentlemen, eventually when your debtor pays you, you are going to deposit that money into your bank account. So what happens with the balance on that bank account, which is an asset? Does it increase or decrease when you deposit the money from the income? It will increase. It will increase. Thank you. It'll increase. It'll become more. You've got money in the bank account. You deposit more money into the bank account. So that balance increases. It becomes larger. Thank you all for all those answers. Perfect. Perfect. So you can see that is quite an obvious one. Now let's look at the other possibility, ladies and gentlemen. Let's say you have a bank overdraft, right? You have a bank overdraft. That means you owe money to your bank, right? Is that then in that case, therefore, an asset or a liability, the bank overdraft? Yo, you guys are quick. Absolutely correct. So now it is a liability. It is not an asset anymore. It's a liability. Now let's think about the same scenario. If you are generating income and your debtor, if it could either be cash income or on credit, but eventually your debtor must pay you, right? Thanks for all those answers. You are spot on. So when your customer or your debtor pays you, you deposit that money into your bank account. Does that overdraft, which is a liability, does that now increase or decrease? There are so many answers, I've got to manually scroll down. Thank you. You are all again spot on. So that overdraft, which is a liability, will now decrease. So in both those cases, you can see that it satisfies the definition of an income because it's either going to increase some asset, like your bank account, or even your debtor's control account, or it's going to decrease a liability, right? So that one, I think we've all got now under our belt. So now let's proceed to the definition of an expense. So if we look at an expense there, like I said earlier, this is basically the mirror image. You know, if you look into a mirror, your left hand looks like your right hand, and your right hand looks like your left hand, doesn't it? Okay, so it's basically a mirror image of the income definition. So they say an expense is once again either or, right? Either or, it's not both. An expense is either a decrease in assets or an increase in liabilities, resulting now in a decrease in equity. In other words, that value, where is it? There it is. That value, your assets minus liabilities, which is your residual interest, which is just another name for your equity, that will then also decrease, sorry, right? So resulting in a decrease in equity. But then again, that little proviso at the end, other than distributions to holders of equity claims, right? So we're going to come back to that just now so that we can use an example. But again, we now know that the holders of equity claims are the owners of whichever kind of business it is. So it simply means in the case of a sole proprietor or in the case of a partnership, it does not contribute drawings, right? So drawings would be distributions to holders of an equity claim or equity claim. So that does not qualify as an expense. Therefore, it is a distribution of retained earnings, as we shall see later on, right? So the decrease in assets or the increase in liabilities is not because we have distributed money to our owners, but rather because we have incurred an expense. Now let's use that same example that we've used a little bit earlier, ladies and gentlemen. So let us say we have got a positive bank balance. We've got money in the bank. You've already said that is an asset, so I'm not going to ask it again. So that is an asset. So if you incur an expense, whether it's in cash or on credit, eventually, if it's on credit, you will have to pay the supplier or the creditor in any case, right? So in that case, will that asset, which is your bank account, will it increase or will it decrease when you pay for the expense? Decrease. So you can see it's now exactly the opposite to an income. Exactly the opposite, the mirror image, as we've said. Thank you so much. Let's just to complete the argument. Let's say this business has a bank overdraft, so they owe money to the bank. We've already said earlier that then represents a liability. Now, when you have that liability, your bank overdraft, and you pay for the expense out of that bank overdraft, will that liability now increase or decrease? Thank you. You are extremely swift. Yes, the liability will now increase. And as long as it is not money that you've paid to the owners of the business, which is then a distribution to them, then it then satisfies the definition of an expense. Thank you, ladies and gentlemen, for all those answers. So those are the definitions of the five elements of our financial statements. We'll see a little bit later where they fit in. Then, ladies and gentlemen, this is where those of you who are using the 7th edition must be very, very attentive. You might even want to take a note or two, even though I've included it in the notes here. When it comes to the recognition criteria, that has actually changed from the 2010 version of the conceptual framework, which you find in the 7th edition of your textbook, to the 2018 edition, the 2018 version of the conceptual framework, which you find in the 8th edition of the textbook, right? In the old conceptual framework, remember, which we do not use anymore, I'm just mentioning this because I know for a fact, because my wife is a teacher, I know some schools use the old version. So in the old conceptual framework, the recognition criteria were that the flow of future economic benefits caused by this asset or liability are probable, and this asset or liability has a cost or value that can be reliably measured. So this is not part of the conceptual framework anymore. We will see that there are some other standards, IAS 16, for instance, which deals with property, plant, and equipment, which does have this definition or this recognition criteria, right? But that is no longer applicable to all other aspects of the financial statement. So what is, ladies and gentlemen, the new recognition criteria are simply this: assets and liabilities and any resulting income, expenses, oops, that should be a comma, or changes in equity will be recognized if the information provided by the elements is useful for the user. Now, I'm just going to pause there, ladies and gentlemen. What did we say earlier? I know this is quite a long story for you to type, but let's see if you can, please. So, what did we say? What did we call that? There were only two criteria there that we said are essential for the financial statements to be useful. What did we call that overall? Quite a fancy name with big words in it. What did we call those two criteria that we said are essential for the financial statements to be useful to the potential users of financial statements? Ooh, I should have placed a bet on this one. No, I shouldn't bet anymore. I've lost a few to students in recent years. Simunye, I'm not sure what the CFRS stands for. Ah, there we go. Nelisiwe. That is exactly what I was looking for. Nelisiwe, the fundamental qualitative characteristics. Right. So if your financial statements comply with those fundamental qualitative characteristics, then we say they are useful, ladies and gentlemen. And that means that those items that comply with that must be recognized. So when do we therefore recognize any element in the financial statements? As soon as we see that they are relevant and that they give us a faithful representation. Right, ladies and gentlemen, let me just talk about recognition and de-recognition in general. I'm not sure whether I actually think I did not include it in the notes. So maybe you can take a few notes here because it is important. I'm not sure why I didn't type it into the notes. But anyway, what is meant by the term recognition? I'm again going to give you a minute or so. Uh, 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 no, the enhancing qualitative characteristics makes it even better, right? So it makes useful financial statements even better, so it improves them. But your fundamental qualitative characteristics, those two, relevance and faithful representation, are the ones that make it recognizable whether you should recognize any item in your financial statements. Now, ladies and gentlemen, let us just discuss this here. If just give it your best shot. What do you think is meant by recognition? We've now looked at recognition criteria. When should an item be recognized? When it's relevant and when it provides a faithful representation. But what is really meant by recognition? Is it I see a guy walking over there and I know him and I say, hi Paul, how are you? Now I've recognized him. That too. But in financial accounting, it recognition has got a very specific meaning. So I'm going to give you, let's say, 30 seconds for someone to come up with an explanation there, or you can say it in person. You are most welcome. Right, ladies and gentlemen, I'm going to give you a short sort of explanation here. Recognition, simply, there we go. Now we get some answers. Thank you. Record, recordation of business transactions. That's correct. Thank you, Palesa. Pabalelu, is it not the recording of business transactions? You've both got it spot on. That is exactly it, ladies and gentlemen. I couldn't have formulated it better. So recognition is when you actually record a transaction or event for the first time in your books of account. We'll see later on during the course of the semester what our initial books of entry are. We will talk about recording of transactions. In fact, Mr. Adams, I think, is going to start talking about that today. But recognition means that is when you, for the first time, record a transaction such as a purchase transaction or a sales transaction or event. Doesn't necessarily have to be just a transaction. An event such as the acquisition of an asset or the acquisition of a new long-term loan, which basically also comes down to transactions. So that is exactly it. Thank you, Letabo. That is spot on. That is spot on. And gentlemen, sometimes we also have to remove some aspects, some assets or liabilities from our books of account. We'll discuss it in a few seconds or a few minutes when that happens. We also sometimes have to remove some of those items from our financial state, from our books of account. What do we call that process? If someone can type for me there. What do we call that process? It's the opposite of recognition. Thank you, Miss Nibe. Derecognition, right, ladies and gentlemen? That is called derecognition. So the opposite of recognition is derecognition. So recognition, when these recognition criteria are met, obviously, ladies and gentlemen, let me just add this so that we are clear. Also, the definition criteria of one or more of those elements must be met. Okay, so if the definition criteria are met, then we proceed to the recognition criteria. Then we say that element that we've now identified, is it relevant and is it a faithful representation of the phenomena that we are displaying here, right? And derecognition is when you take it out of your books of account. Now, this does not come from the conceptual framework. It actually comes from an interpretation, but there are certain standards which also deal with derecognition. So there are two sets of circumstances generally, ladies and gentlemen, when you derecognize something. Perhaps you can type one of the possibilities for me there. If you can type one of the possibilities, and then I'll mention the other. Let's take the case of an asset first of all. You now know the definition of an asset. So when do you think you will derecognize an asset? There are two sets of circumstances. The one is quite obvious. So I'd like an answer from you there. No, a stale check. A check is not actually an asset. It is a financial instrument. It is a, but there we go, Justin. There we go. Or where to? Letabo, no, you don't have to know the 2010 recognition criteria at all. Okay, just the 2018 ones. So thank you, Justin. Thank you, Olwetu. Thank you, Kolani. Letabo. Okay, there we go. There's a lot now. Okay, thank you so much. So when you sell, when you dispose of that asset, then you have to derecognize it. So that means any balance that relates to that asset, the cost of the asset, the accumulated depreciation on the asset. We'll talk about these terms when we get to property, plant, and equipment. So you have to get rid of all those balances because you no longer own that asset. Then, just as a matter of interest, ladies and gentlemen, the second possibility is when the asset has become worthless, if it has no further value for you. So you can't sell it, you can't use it to produce income. It is simply a lump that sits there, does nothing, and you just have to get rid of it. Okay. So if it has become worthless, then it is also derecognized. Ezelia, I think that is possibly what you are also referring to. It has now become so old that nobody wants it as a second-hand machine or a motor or whatever the asset is, and we can't use it anymore, right? So when it has become, when there is no future economic benefits that can be derived from it, that is the official term. In the case of a liability, it is very similar. In the case of a liability, it is when you have either paid that liability in full, you have either paid it in full, or, ladies and gentlemen, there are no further obligations regarding the liability. So maybe they've written it off or whatever the case may be, if you're very lucky. So you have no further obligation to pay that liability, then also it is derecognized. Okay, ladies and gents, let's just pause there for a brief minute. Are there any questions from your side on either the definition criteria or the recognition criteria? You can ask it in person as always, or you can type it in the chat. Or if you are happy that you understand all of this, you can maybe give me a thumbs up or a happy face. Thank you. There we've got some thumbs up. Thank you, Nangamso. Thank you, Asaki. Everybody, thank you. Right. Okay, so now we can go to the last section, if I remember correctly, that we need to discuss, and that is the measurement of the elements. The measurement of the there's some beautiful happy faces there as well. Thank you so much. Yeah, I always have a good laugh at that. Thank you very much. Okay, so the measurement of elements, ladies and gentlemen, let us perhaps just talk about uh, the measurement of elements before we go into the detail. Let's just talk about it generally. When we get to when we get to the specific standards, you remember we said last week that those standards supersede the conceptual framework. But if there is no standard covering a specific area, then obviously the conceptual framework will apply. Now, most of the standards will give you certain definitions that apply to that very specific element. Let's say it's property, plant, and equipment or financial assets. They will also give you guidelines regarding the recording thereof. They will give you recognition criteria over and above these these we find in the conceptual framework. Then, ladies and gentlemen, they will also give you various measurement criteria. How do you actually measure that specific item in your financial statements? You already know from school. Thank you all for those beautiful smileys. Uh, that in the case of property, plant, and equipment, the measurement is not only at cost anymore, it is at its carrying value or its carrying amount, which means that we have to take depreciation into account. So some of the subsequent standards have got further measurement criteria, and then those standards also provide us with disclosure requirements. How should those items be disclosed, presented in the financial statements, and disclosed in the financial statements, including the notes? But these measurement criteria apply to anything except if there is a standard for that specific item, right? So here simply we said the term measurement refers to the process of deciding or calculating the amount that we are going to use or disclose in our financial statements. And then the conceptual framework provides us with a few let's call it manners in which we can do that. So there are a number of different methods or manners or possible measurement bases that may be used to measure the amounts of individual elements, such as assets and liabilities, income, expenses that we recognize in the financial statements. The one, ladies and gentlemen, is the historical cost method, or the historical cost basis, I should say. I think they normally refer to it as bases. So the historical cost basis is probably the method that is used in, I would guess, 90% of cases, right? So what is the historical cost, ladies and gentlemen? It is simply its cash value. So if you should go out and you should acquire, let's say, an asset, a motor vehicle, for 50,000 rands, that is what it's costing you. That will forever remains its historical cost. So you're going to carry that historical cost in your books of account until such time as you derecognize that asset. We've just spoken about derecognition. I have to add there, it does not mean that your valuation cannot decrease. Your valuation can decrease, but then we are going to achieve that by means of what we sometimes refer to as a negative asset. A typical example, again, is where your historical cost is the cost of a motor vehicle, but you have depreciated it over the last 2 or 3 or 4 years, and then you accumulate that each year's depreciation on an account which we call the accumulated depreciation for that asset account, and that is then referred to as a negative asset. So the carrying value or amount that you are going to disclose in your financial statements will then be the historical cost less your accumulated depreciation. Then, ladies and gentlemen, the other possibility is a current value. And there they actually split it up into two possibilities when it comes to a current value, either a fair value or its value in use. So perhaps let's just discuss that. What is meant by its fair value, ladies and gentlemen? Its fair value is what you can sell it for if you should sell it today, right? So the fair value, And we're going to encounter that term a lot over the next few years in financial accounting 1, 2, and 3, and so forth. So the fair value, any asset's fair value, is what it is truly worth on that date, right? So if on that date you can sell it, what you can sell it for. Another possibility for the current value method, ladies and gentlemen, is its value in use. Its value in use. And that is quite a complicated calculation which we do in our third year, Financial Accounting 3. But I'm just going to tell you what it means. It means to what extent does that asset provide you with future economic benefits? What is the future economic benefits that can still be derived from using this asset, right? So you can see those two are quite different from one another. The fair value method is what I can sell it for now if I don't use that asset anymore. And the value in use is the value that I can derive from that asset if I do not sell it today, but I continue using it into the future. Can you think of anything that is a typical estimate of a value in use? I know this is a big trick question, so I'm going to answer it myself. A typical example of an estimate of the value in use is actually the carrying amount of property, plant, and equipment. So when you disclose your property, plant, and equipment at its carrying amount, right, it means you've taken the historical cost less the accumulated depreciation. And remember, the accumulated depreciation represents what you believe your usage is, your usage of that asset. In other words, by how much has it declined in value, right? And then the carrying amount is your estimate of its value in use. What does it provide us, if you want to quantify it, as possible economic benefits into the future? Ladies and gentlemen, those were quite mouthfuls. Are you happy with that? You know what the difference is between historical cost and current value? And you know what the difference is when it comes to current value, the fair value, right? What it is worth today if I should sell it, or the value in use, what it can provide for us if we carry on using it as we originally intended. Doesn't seem to be any no's. Okay, so then let us go and have a look at the current cost method in the case of assets, and the fulfillment value method when it comes to liabilities, ladies and gents. So what does that mean? So this is another measurement basis that you can use, that you are allowed to use. Oh, sorry, that you are allowed to use. The current cost method in the case of an asset, ladies and gentlemen, what that means is that you can value your assets at what a similar asset of the same age would cost you if you should acquire or buy or purchase it today. As you can see, the difference between the current value method, the fair value part thereof, is what you can get for it if you should sell your asset, right? But the current cost method is what will it cost you if you should replace your asset with a similar asset. And when we say similar asset, it must be almost identical, it must be of the same age, and so forth, right? So that you can also use that as a valuation or measurement basis. In the case of a liability, it is a similar principle, but they call it the fulfillment value method. So that means if I should settle that liability today, I'm not going to pay it off over the next 2 or 3 or 4 years, which I will be incurring interest in now. I don't incur any further interest. So if I should pay off entirely that liability today, what is it going to cost me, right? So what do I have? They also sometimes refer to that as the settlement amount. So what is the settlement amount that I will have to pay for that liability if I should pay for it today, if I should settle it in full today? Okay, ladies and gentlemen, I've used up a little bit more than the half hour that I sort of promised Mr. Adams that I won't be more than half an hour. So I'm just going to give you a minute or two if there are any questions, ladies and gents, and then I'm going to hand over to Mr. Adams. Mr. Adams, I'm just going to stop this recording when we are done, and I'm going to start a new one when you start, simply because they have to be loaded under different folders on Blackboard. So it has to be two separate recordings. So any questions from your side, ladies and gents? Anything in the conceptual framework? The full document is also available on Blackboard, but I guess these notes are the ones that most of you will go through. It is, I've already posted it there. Mr. Pokelo, yes, you've got a question?
Hello, sir. How are you?
Hello, no, I'm very well, thank you. And you?
I'm fine. Can you please repeat the fulfillment value method? Can you please?
Which one? The fulfillment value. Sorry, did you say the fulfillment value?
Yes, the fulfillment value.
Thank you. Thank you. Sorry, my loudspeakers were actually a little bit low, but now I can hear clearly. Okay. The current cost method and the fulfillment value method are sort of similar principles, but in the case of the current cost method, it relates to assets. So in other words, that means I know I'm repeating what you didn't ask. So that means what will a similar asset cost me if I should purchase one to replace an old one today, right? The fulfillment value that relates to liabilities, but it's a similar principle. So what that means, if I should settle, let's say you've got a long-term loan. Let's maybe expand on that, right? You've got a 5-year long-term loan, and this is the first year in which you are going to be in which you actually have that loan, right? So at the end of the first year in which you have that loan, you still expect to pay a further 4 years on that loan, right? You all agree. So you still expect that you are to be paying for another 4 years. Um, so uh, very often, what accountants do here, they then go and capitalize the future interest, right? The future interest, but that is actually not solid accounting principles. You should not be capitalizing future interest, only historical interest. So let's say the outstanding balance on that loan at the end of the first year, just to make it easy for us, let's say it's 100,000 rands, right? So the outstanding balance at the end of this financial year is 100,000 rands. But if you should continue to pay it off over the next 4 years, you are going to incur interest over the next 4 years of, let's say, 40,000 rands, right? So what that means is that basically, if you are going to use the fulfillment value, perhaps somebody can type it for me here. If you use the fulfillment value, what should you then measure that loan at the end of the first year? 100,000 or 140,000? Remember, the fulfillment value means that you are measuring that loan at the value that it will cost you to settle it if you should settle it on that day. How much are you going to pay that lender if you should settle the full loan on that day, on the last day of that first year? Have you incurred the next 4 years' interest yet? Thank you, Nangamsa. Thank you for everyone who's made an attempt. I respect every attempt, whether it's right or wrong, doesn't really matter, because at the end of the day, we get to the right answer. But Nangamsa has got the correct answer there. If at the end of that first year, you suddenly see you don't need that loan anymore, I can now repay it to the bank. The bank will only expect that 100,000 capital that's outstanding, because that 40,000 of interest would only have been incurred in the second year and the third year and the fourth year and the fifth and final year. So that has not accrued yet. Remember, we spoke about the accrual principle last week as well. So that interest expense has not accrued yet, not accrued as an expense for us, and it has not accrued as an income for the bank or financial institution either. So if you should settle it at the end of the first year, you will have to pay 100,000 rands. That interest, the future interest will fall away. Only the interest that you incurred in your first year would then have been paid. Does that make sense? Are you happy now, Lucello?
Yes, yes.
Okay. Yeah, so maybe I should from the start have given an example there, but at least I think we're all on the same page there. Thank you, Nizla. Yes, thank you so much, ladies and gents. Okay, then if there are no further questions, then I'm going to sign out. Thank you very much, Lichle, and everybody else. Thank you so much. I'll still be in the session, but I'm going to hand over to Mr. Adams now. Mr. Adams, perhaps we can just give them a minute or so break, or let's make it 2 minutes, the 2 minute break that they can just go for a little ablution if necessary, or have a swig of
Yes,
water.
Mr. Jansma, good morning. Students, you can have a break quickly for two minutes while we